Right. Thank you very much. And we want to welcome you to this webinar. We are privileged to basically host you for this webinar, whereby we'll be talking about the insurance innovation portraits based on a study that we conducted a couple of months ago. So 6 months ago, ourselves as FSD Africa, we looked into reviewing and assessing the state of insurance innovation in Africa. And this basically made us to look at 8 countries, and we were privileged to work with 8 countries in Sub-Saharan Africa, which was Ethiopia, Kenya, Malawi, Uganda, Rwanda, Nigeria, Ghana, and Zimbabwe. And this basically enables us to take stock to the challenges and the barriers within the innovation ecosystem, particularly given that we have a number of challenges that are currently impacting the insurance industry, but also looking into reducing the protection gap that we are still experiencing within the continent. Over and above that, this basically follows the launch of Risk, Resilience and Regulatory Lab that we launched in Nigeria in March. And ideally, that particular program was looking at ways in which you could catalyze change within the insurance industry by looking at which areas that we need to catalyze. And in this particular case, we started with this particular project whereby we are looking at how then do we enable innovation within the insurance ecosystem. So it's really, really important for us to be with you this particular afternoon, and we'll be sharing some of the insights that we've managed to gather through this particular study. We were privileged to work closely with Senfree to undertake this particular project, and we are happy that we'll be sharing some of the insights out of this particular study. Also, above that, we are looking into ways in which we can continue supporting the insurance ecosystem, because as FSD Africa, we look at making finance work for Africa, and we believe that by enabling the industry to become more resilient by providing products that meet the needs of customers, but also providing ways in which these particular customers can be reached in a more effective manner, but also an easy way that they can access these particular products, then enable us to build that particular resilience. Over time, we know that we are going to really continue bringing these particular studies to the people that are joining us today. And we are happy to have each and every person that is joining this particular afternoon. But also, I just want to kind of give you some housekeeping rules here, which will remind you that you can send us your questions through the Q&A box. We'll be having a presentation, and thereafter we are going to have a panel discussion, whereby we are going to have with us Mr. Robson Tandura from Zimbabwe, together with Christine Gat from Senfree, whereby we'll just be discussing some of the issues that are happening across the continent when it comes to innovation, but also looking specifically what Zimbabwe as a country has been doing, because Zimbabwe was one of the countries that we basically undertook this particular assignment. Together with us today, we have Mr. Kelvin Masinya, who is the Director for Risk and Resilience. He will be able to kind of give us some keynote address, and thereafter we'll get into the discussion with Jeremy taking us through a presentation. Thereafter, I'll come back in to take over the panel discussion. Mine is to thank you for joining us, and hopefully we are going to have a very fruitful discussion. Just know that kindly post your questions. We are going to answer them, and also we are going to ensure that we address the issues that we are going to have when it comes to the insurance innovation. Thank you. Welcome, Mr. Calvert.
Thank you very much, Elias, and a very warm welcome from my side as well to everyone joining us today. It's really great to have you with us. I'm Director of Risk and Resilience at FSD Africa, and we're delighted to, together with Senfree, present the results of this work on insurance innovation in key markets in Africa, and how we can really drive this forward. The work is brought to you, as Elias said, by an initiative that's broader than just this, which is R3 Lab, which is a platform for capacity building and peer exchange to create the right type of enabling environment for the insurance industry in Africa, and to address some of the challenges that we face, and to work together to provide African solutions to these problems. And so we're excited about that initiative, but also about this work on innovation, which is really essential. We know the challenges that we face in terms of leveraging insurance as a tool to deliver resilience on the continent. But there's lots of barriers, and really innovation is essential to kind of tackle those challenges, to enable customer-centric solutions, to enable solutions that are cost-effective, and also to leverage the power of data to inform decision-making. And so we're very keen to develop the whole innovation ecosystem. So as FSD Africa, we're working through this work on the regulatory side through R3 Lab to create the right enabling environment, and really that's what this webinar is about. But we're also working with the private sector to catalyze the startup ecosystem with initiatives like Beamer Lab, but also working with incumbent insurance companies to really drive new business models and new products that meet needs. And this is important because we're actually trying to reach those that are currently vulnerable, that don't have the advantage of safety nets that mechanisms like insurance provide. And really innovation is critical to delivering solutions to customers and businesses like that. And so that's why we're doing this. We're really excited to present this research today that Century's conducted on the state of innovation in 8 sub-Saharan African markets, and really looking at some of the challenges to innovation, but also some recommendations and action plans that we can take forward. And that's also what we're very keen to do. This doesn't stop with just presenting the results. We'll be working in each of these 8 countries to take forward these action plans and to actually see them implemented, and see ultimately end beneficiaries receive the benefits of innovation happening in the markets. So really looking forward to it. And I think with that, we'll hand over to Christine.
Thank you, Calvin, and thanks, Elias. So yeah, I think that's a really good introduction. So I'm not going to actually try and repeat too much, but I think this has been a really interesting project that we've had the fortune of working with FSD Africa on, to identify opportunities, to understand the innovation enabling environment across the 8 countries that we looked at, and identify opportunities for regulators to better support the enabling environment in each of those countries. And I think it's a really exciting time that we see across the continent in terms of how insurance innovation is starting to grow, and the opportunities for regulators to play a key role in supporting that enabling environment. And I think for everyone on the call, I know that we don't just have regulators joining here. So whilst much of the recommendations and suggestions here speak to imperatives for regulators to consider, I think it's equally important for private sector players to be quite, to understand the perspective that regulators are coming from, to understand the challenges and the balance and the trade-offs that regulators are coming from, because increasingly, as we see more innovation entering financial markets, the need to collaborate between private sector and regulators becomes increasingly important. As we see new innovation coming into the market that no one really fully understands the full implications of or the full risks of, it's equally important to work together through private sector and public sector to enable that innovation to flourish, but in a way that is responsible and ensures that consumers in the market remains protected. And I think that really speaks to the heart of the objective that we outlined, or the rationale for doing the study. So we see it across Africa, and as Calvin said, building resilient solutions across the continent is critical because of the high level of vulnerable people that we see, vulnerable people and other support services across the continent that can benefit from insurance. We see insurance penetration being really low compared to the global average. And innovation is key to developing new products, new solutions, new distribution channels in order to overcome the challenges and to increase that level of insurance penetration and more importantly, the value of insurance and the reach of insurance to people and businesses who really need it. So from the regulator's perspective, and really at the heart of this study, is looking at how do regulators balance these dual objectives. On the one hand, regulators want to promote market development. They want to encourage innovation. And increasingly, we see across the continent, regulatory authorities being given a legal mandate, a legal responsibility to encourage market development within the insurance acts. So this is something that is central, increasingly central to what insurance regulators need to deliver on. But the traditional mandates of maintaining prudential stability and market conduct, consumer protection, still remains core mandates and responsibilities for the regulator. And as you can imagine, balancing those two against each other, sometimes they can be complementary. A really good innovation can also add additional value to consumers and really supports both these objectives. But it's often not that simple. Often when a new innovation comes into the market that we don't fully understand, we aren't clear on what kind of risks may manifest for consumers. And so it does require a balancing act for regulators in order to be able to manage that trade-off. One of the innovations that we've seen over the last few years really proliferating, not just across Africa, but really across the world, is regulatory sandboxes, because regulatory sandboxes in principle help to balance those two objectives. They help to enable innovators to test a new product in a safe space with effective safeguards that ensure that the risk that is introduced into the market is not excessive or substantive. Often safeguards are things like you can only reach a certain number of customers or generate a certain amount of capital. So although there's some risk into the market, it's at a proportionate level. However, what we've seen from the work that we've done, and that I'll elaborate on further, is that while sandboxes can be a useful tool, and the principles underlying a sandbox are quite centrally defined as per this trade-off, there is a broad set of tools that regulators can leverage. And often, sometimes, and some of the things may seem or seem to you to be quite simple, but sometimes the simplest solutions actually have, or the simplest interventions can actually have the biggest impact. And I'll get into some of that a bit later. So briefly, Calvin and Elias have introduced the R3 Lab, which acts as a platform, capacity building, and peer exchange across regulators, and it's under the R3 Lab that this project falls. And so the objective of this project was to help to inform the R3 Lab on what is the state of innovation across the 8 countries that we looked at, and what are the potential opportunities to enhance the role that regulators can play in supporting innovation in those markets. And how we went about this was we looked firstly at what the current state of innovation in each of those markets looked like. We then looked at what does the enabling environment look like. So it's all well and good to look at what the current state of innovation is. But if we want to think about how to develop innovation in those markets over the medium to longer term, we need to understand what is the enabling environment. What are the key factors that and barriers to potential innovators or existing players innovating in that market? And we looked at 6 criteria, as you can see on the slide here, to try and understand that enabling environment. And then from there, we, both from looking at practices and tools that have been applied globally, as well as by engaging across in depth in each of these countries, we have identified some specific interventions and actions that regulators can take to enhance their ability to manage that balance, to responsibly encourage innovation. So we do see a number of innovations emerging across the continent. And I think what's really important to note here, and came up in a lot of our discussions, is that when we talk about innovation, we often immediately jump to think about insurtech or fintech. That is the thing that is seen as the cutting edge of innovation. But innovation is a much broader concept than just insurtechs or even just digital technology. It's really the introduction of anything new, whether it's an idea, a method, a device, or a process. So it goes beyond just fintech, it goes beyond just digital insurance. And this is not even a comprehensive list, but some of the common types of innovation that we do see is, yes, in the insurtech space, we see a growing number of insurtechs emerging, but we also see increasing numbers of distribution or different types of distribution partnerships with new types of distributors and aggregators. We see increasing use of technology, both by insurers, but also by aggregators, distributors, and of course, insurtechs. And we see some product innovation happening as well. So innovation can really happen across multiple layers. The one thing I also want to emphasize about the point around focusing around insurtechs or fintechs and why that's important to consider is that much of the innovation that we would expect to see, certainly in the short to medium term in the African markets, most likely is going to come from your more established players, from the established insurers who have the capital and the customer base to be able to leverage, to develop new products, to employ new technology, to partner with new partner with new distributors. However, engaging with the fintech community, engaging with the tech community, the ICT community, and especially insurtechs is really, really important if you're thinking about how to drive innovation. Because even though, certainly at least in the short term, in most markets, insurtechs are unlikely to take a substantive portion of market share. Often they're quite small, they're growing, they're testing new models. They're really important in driving innovation across the market. For one thing, they bring in new ideas. So they bring new ideas and demonstrate to established providers the types of innovative things they could be doing. They're also important partners for insurance. So they bring technology or other types of solutions that can enable existing players to operate a lot more efficiently, to reach new markets, to test new ideas. And then lastly, they do bring competition into the market. So they do create competition and perceived competition for existing players, which can act then as a stimulant or a nudge for existing players to also consider how can they adapt, how can they respond, how can they innovate in order to ensure that their market share doesn't get taken away over time. And I think, looking at outside of insurance, an example of that really, I think, is mobile money, where we saw the MNOs come in initially offering mobile money, and in many cases not gaining a significant portion of market traction very quickly. But as they started to gain traction, we saw that competition, and they saw the demonstration case they provided of offering, for example, agent networks to provide payment services. The competition that they provided has led to many banks following suit and setting up similar types of services and offering greater competition and value in that market, in that payments market. So what we looked at then, or one of the ways we looked at this, is look at both market development and innovation. So market development to me is really a broader concept than innovation. Market development is the process of growth, development, and increasing sophistication of the insurance market to promote access to insurance and to better serve the risk management needs of the economy. So it speaks to both the need to reach people, to include people, but it also speaks to some of the fundamental needs. A well-developed market needs to effectively cover, address, help to manage the risks across the economy, which includes those large corporate risks, national risks, as well as at the more micro level. Innovation, therefore, is a key driver of market development, but market development is a broader concept than just innovation. And we actually applied, the Access to Insurance Initiative published a proposed set of indicators to measure market development, which is what we applied to the countries that we looked at to assess where they fall in terms of the level of market development. And one of the things I want to point out here is that if you look at the correlation between where they sit on this broad index of market development against penetration rate at the bottom, there is only a very limited correlation between those two indicators. And so one of the key takeaways from the study that we found is that in many countries, in fact, I would say in most countries, although regulators have been handed or been given a market development mandate, how their KPIs are set, how they measure market development often remains limited to penetration rate, gross written premiums divided by GDP, or penetration rate and the number of adults covered. Now, both of those are important indicators. They show outcomes, but they're not comprehensive. Penetration rates in particular, as I think everyone on the call will I suspect agree with me, is a flawed indicator. For one thing, it's affected by GDP, which is largely beyond the control of the insurance industry, but it's also quite significantly affected by, for instance, one individual large policy on sale, say an oil and gas rig, can substantially increase gross written premiums in a market. I'm not sure we can really say that, one or two large policies leads to a fundamental intuitive sense of a more developed market. A more developed market is one that is able to offer greater value to a larger portion of people and address risks across a broader set of populations. So those large risks are really important that they're managed, but it also implies that limiting ourselves to measuring market development only by penetration and by number of adults covered is somewhat limited in our understanding of market development. And so that broader set of indicators can be quite important in understanding that broader concept in order to ensure that the interventions that we focus on and prioritize are targeted at the right things, so that we're measuring things like number of new products coming into the market, level of skills in the market, et cetera, et cetera. So we're understanding not just what the outcome indicators are, but also what the input indicators are to driving market development, and therefore that regulators can direct their attention to those things that are most important. Now, what is also interesting about this matrix is that when we mapped market development against level of innovation, both into the three different categories, we see that on the whole, the level of innovation largely follows market development. So most of the countries fall into the diagonal across the slide. And that makes sense, in intuitive sense. Innovation happens in a market that is showing and demonstrating more development. There are some exceptions that also show some interesting dynamics. So Zimbabwe, for example, has a higher level of innovation than we scored on the when looking at it from a market development perspective. And some of the challenges that Zimbabwe faces is the macroeconomic conditions, which undermines the ability or sort of undermines the long-term market development of the insurance industry. Things like, hyperinflation, the significant challenges, and political instability has significant challenges in developing the market. And it's actually really interesting to see in Zimbabwe that despite that, we do see insurers and other insurance providers being quite creative in developing new types of solutions and new types of approaches to still innovate despite those challenges. So from this, we have sort of 4 categories that we've identified around imperatives that regulators and industry can look to address. So this builds from looking at what the enabling environment looks like, what are the main constraints within that enabling environment, and then what are the things we can do about that. So the first category is the structural constraints. And across the 8 countries that we looked at, the most common structural constraints we saw was high mobile data costs, at least relative to incomes. And that's important if you're thinking about digital technologies and a way to distribute products that are not in person, so via data channels. Low awareness and a lack of trust is fairly consistent across many markets, or most markets, and then a large skills gap as well. Now, structural constraints largely don't fall directly under the responsibility or the mandate even of the regulator. But that doesn't mean that there isn't anything that the regulator can do to support and to help overcome these structural constraints. So for example, if there's issues with infrastructure, the insurance regulator can leverage its role within existing government coordination structures, lobby or advocate, rather is a better word, with other ministries, with other regulators to help to overcome those challenges. Now, as I say, the insurance regulator can't directly overcome issues around high mobile data costs, but by engaging with the telecommunications regulator, for example, they can start to raise concerns around from the insurance industry's perspective that can over time potentially lead to overcoming those. So the regulator can act as an advocate for the insurance industry around some of these structural constraints. And I think building skills is also really important. In Rwanda is a good example, which falls beyond the role of the insurance regulator specifically, but their reduction in visa requirements has enabled them to attract skilled professionals. And also there's been a deliberate push by the Rwandan government to set up or to incentivize Pan-African tertiary institutions to operate in their country and then provide work visas directly to all graduates, which helps to build the level of skills within their market and which benefits a number of sectors, including the insurance sector. The market constraints, and if we look at the market constraints, are limited understanding amongst large untapped markets, limited investment, challenges in forming partnerships, and limited funding to insurtechs. Now, again, these are not functions directly under the control of the regulator, but it doesn't mean that the regulator doesn't have a role to play. Some of the things that the regulator can do, for instance, is to help identify where there are information gaps. One of the issues around with that many providers face is if they're trying to target a new product, a new target segment, for example, trying to reach MSMEs, which is a heavily underserved market segment. There's a lack of data and lack of information on that market, which makes it quite expensive for them to enter into that new market and difficult for them to justify internally the expense required to first understand the market and then develop products to pilot. So where there are those data or information gaps around underserved segments of the population, the regulator as a neutral provider can play a role in developing or commissioning research or similar types of data gathering exercises to help to inform the entire market better around those gaps. And in many cases, that may not be possible for the regulators themselves to do, but they can certainly flag or work with development partners to help fill those information gaps. And then also, I think the other key one to highlight here is around proactive market engagement to prompt innovation, so to nudge and highlight the importance of innovation and to demonstrate opportunities. So demonstration cases, such as bringing providers from other markets that have been successful in innovating to demonstrate to the local market about the types of things that they could do. And then to encourage partnerships. We see for insurtechs particularly and fintechs, early stage players, partnerships is absolutely critical to their early stage development. It's quite difficult to access to investor funding if you don't have a track record as an insurtech. Often the way entry into the market is through partnerships and the fees earned through those partnerships for insurtechs. And that should have mutually beneficial benefits for both the insurtech and the insurer through the provision of those services. In practice, we do see many insurers quite risk averse in those types of partnerships. So where the regulators can help, even by providing a convening platform where different types of players can have the opportunity to engage with each other, they can at least help to create a more vibrant and innovative ecosystem. Now, moving on to regulatory constraints, which does then fall more directly under the responsibility of the regulator. Some of the key challenges that were identified is a lack of clarity around certain guidelines and regulations, limited license categories. I mentioned regulatory sandboxes at the beginning. Whilst they some have had some success, we do see broadly across the region, many of them have not been as successful as hoped. And in some cases, microinsurance frameworks are not always fully utilized, despite them being increasingly prevalent across the region. So some of the imperatives, for instance, that can be identified as closing some of the remaining gaps, particularly for license categories. What we see in most markets is that there are license categories limited to agents, brokers, insurers, and reinsurers, and then sometimes microinsurers as well. But many of the innovative players don't fall neatly into any of those categories. If you take some of the technical service providers, for example, like an Inclusivity Solutions or a microinsurer, they're not a broker because they're not directly, or most generally not directly selling products to the end consumer. They're partnering with an aggregator to provide that service. And they're also not providing underwriting service. They're not also not underwriting those policies. So they're not an insurer or a microinsurer. They fall between those two. Now, that means that they are complying with, if they're operating as most commonly is the case under a broker license, then they're complying with requirements that are not strictly relevant to their existing business, but they're also probably doing business that doesn't fall under those license categories, and so is not strictly being supervised. And so closing some of those gaps helps to provide greater space for different kind of innovators to operate. And I think Ghana's New Insurance Act is a really good example of this, where they have provided quite an extensive list of the different types of intermediaries that they're willing to license in the market. That includes technical service providers, includes insurance aggregators, also includes third-party cell capitals. So they provided space for innovative aggregators or innovative players rather, not just aggregators, to operate in the market, sometimes even before they're currently operating. But providing that legal space acts as a signal to innovators that there is an opportunity and a neat space for them to operate within. Now, the last set of constraints is the supervisory constraints. And whilst there are certainly some regulatory constraints, regulatory constraints, what we do see is that, and there's certainly some regulatory gaps that can be closed and regulatory gray areas that can be clarified. In most cases, like the regulatory constraints are not the biggest constraints for particularly new entrants and people innovating. if you take that point that I talk about technical service providers, it would definitely be preferable to have a license that is tailored to the specific business that is being done by those TSPs. But they can and have successfully operated under a broker license, and the requirements are not usually extremely onerous to operate under a broker license. And so what we've seen, and then furthermore, regulation often takes time and quite a lot of capacity to adjust and amend and change, and particularly when it has to go through legislative change as well. So where we see the biggest opportunities and often sort of the quick wins, but quick wins doesn't mean insubstantial impact, is really on the supervisory side. So some of the key supervisory constraints identified is, the supervisory process is being onerous, communication efforts not yet being as effective as they could be, and monitoring systems not always set up to provide granular monitoring of innovation. And I think there are some really relatively simple steps that many regulators can take on this side that can have significant positive impacts in encouraging innovation and how they engage in the market. So one is around really building up your communication capacity, bilateral communication with industry. So bilateral is really important. So one is you want to engage with industry, and not just existing regulated entities, but also potential entrants into the market. So you want to engage with them to nudge them and demonstrate or highlight demonstration cases to how they can innovate, or that they should be innovating. So just providing that nudge, that moral suasion. But the bilateral communication is really important, so that it's a discussion, so that they can also flag on an ongoing basis to you as the regulator, what are the key challenges that we are facing in the market? And for providers, that's equally important. They need to see themselves as partners to the regulator and be proactive in flagging what the barriers and constraints there are that they're facing in terms of innovation. So communication and creating that relatively easy pathway of engagement to hook into the regulator can be really impactful and powerful in shaping and nudging incentives and direction of industry players. I think the other one is that if we look at guidance, now often we rely, when we talk of the need for regulatory change, when there's uncertainties in regulation, the response is often to issue more regulation or amend existing regulation. And sometimes that's required, but often it's not necessary to pass new regulation. A much more quicker and more flexible approach is to issue guidance papers. Now, by guidance, I mean non-legally binding guidance. So it may not have strictly legal standing, but if a regulator issues something that says, this is how we perceive a certain issue in the market, that is something that is going to guide and shape how providers in the market respond and operate. And we've seen in markets like South Africa and in Singapore, where they've done this really effectively, provided guidance papers that really give clarity to the market on how they see certain innovations and shape the direction of development of those innovations by private sector players. And guidance papers guidance can really serve two distinct purposes. So one is clarity. So where there's uncertainty in regulation, so for example, if you keep getting the same questions over and over again, provide clarity so that there's much more certainty in terms of what providers need to comply with in the market. For example, a common one that comes up is where requirements for a license or for a product application are not clear, and providers feel like they need to keep giving more information because they aren't provided up front with a list of documents they need to submit. That's not the case in every market, but it's one that does come up relatively regularly. Providing just clarity and guidance on this is the set of documentation required helps to provide that clarity and simplify the process. The second, though, is where we see new innovations emerging. So where there are new innovations emerging that we don't yet fully understand, and we don't yet fully understand the risks of, we probably don't want to jump immediately to regulation. But what we probably do want to do is to issue a guidance paper that says, this is how we understand this innovation. This is how we understand it manifesting and the potential opportunities in the market. We're therefore, as the regulator, willing to accommodate this type of innovation to operate, but we're aware, or we think that these are the key risks that will emerge from this innovation. And this is how we would like providers who are engaging in this innovation to address those risks. And then it's up to any providers who want to work within that innovation to operate, to offer that innovation, to comply with that guidance. If they don't, or at least demonstrate to the regulator how they are mitigating the risks that the regulator has identified, or show to the regulator that they have overstated the level of risks that the regulator initially thought. And the risk and although it's not legally binding, almost all providers will comply with that guidance, because if they don't, they know that that guidance can quickly be turned into regulation at some point, and then they'll fall afoul of existing regulations. So we see, for example, again, in Singapore is an excellent example of how they use this as a tool, where they provided a series of 6 guidance papers around artificial intelligence. They are not entirely sure about how artificial intelligence will manifest in the financial sector, and they don't want to jump to regulation immediately. So they provide guidance papers that help to guide and shape the incentives within the market, and through that also open a proactive discussion with the market around that. So supervisory imperatives and the other things as well, I think, like improving the product approval process is something that can be done quite effectively through a product approval committee, so that you bring in different departments together, so that you're directly in a product approval decision process, balancing both the need to encourage innovation, because you bring in, say, a market development department as part of that decision, as well as balancing the risks. So you still have the actuarial department as part of that decision. So you're actively together working through that trade-off. So in conclusion, I think this is really quite simple at a conceptual level, but can be really quite powerful, which is, one is for regulators don't function in single departments. There are many departments in an insurance regulator, and they need to be working towards the same objectives. So when we're talking about innovation or market development, that's often driven by an individual department within the regulator. So the first is to ensure buy-in and shared responsibility across departments. If you have a market development department or a fintech innovation or an innovation hub within the regulator, they have an important role as being the engine within the regulator to drive that objective, but they need to work with the different departments to achieve holistic market objectives. So one is decide the objectives together and develop a strategy, then compile a specific work plan together that articulates who's responsible for what, then implement, and then form monitors, really important. So that point I made earlier about the KPIs that we track is really important to identify where are the weaknesses or the challenges in the market, and therefore where do we need to focus our interventions, so that when we iterate into the next year's work plan, we take that into account accordingly. So lastly, I think market development is, or we see market development mandate being increasingly common amongst not just insurance regulators, but financial regulators more broadly. And so far, it seems to be a positive step in creating the right incentives for market development, as well as creating incentives to create the desired capacity to drive it forward. And regulators have a range of tools in order to drive and support that innovation. And as I've emphasized, many of those can be relatively easy or low-cost interventions, but can actually create quite significant impact on the market by creating transparency, by signaling and engaging proactively in the market, creates a far more conducive environment for innovation. So as much as innovation sometimes may seem scary, some of the interventions for regulators to take are often, not as complex as may be thought, but can have quite significant positive impact. Thank you very much, Elias. I'll hand over to you.
Right. Thank you very much. And thank you, Jeremy, for that presentation. Ideally, we believe that regulators have a key role to unlock innovation at scale, but also just to look at how the market players need to interact with them, because ideally for any innovation to gain the right traction, there are a couple of things that need to be done. And we've kind of looked at 6 key components during the assessment that was conducted within this particular study. And we are going to really follow up on those action points that have been highlighted out of the 8 countries. And we believe that that would be able and will enable us to catalyze the insurance market towards creating more resilience within this continent, but also just enabling spurring of new talent to come into the insurance ecosystem. So I'm privileged to also have a panel with me. This afternoon. And we are going just to have a conversation, ideally on some of the outcomes that we've seen in Zimbabwe, but also we are going to also look at some of the key issues or recommendations that needs to be implemented across the other 8 countries. And this will kind of give us an idea of what we need to do now, because one of the key things that we noted is that some of the recommendations, some are short-term, some are medium-term, and some are long-term. And we need to start doing some of this and taking these recommendations and taking the actions that are needed to transform the market in Africa. As we've mentioned, RT Lab is looking out of how then we could synthesize some of the outcomes within the ecosystem. And ideally, we believe by creating an enabling environment, we'll be able to change the landscape that we are currently experiencing in the continent. So with me, I have Robson Mtangandura. He's an actuarial director at IPEC, the regulatory authority in Zimbabwe. And also we have Christine. And I'll just give them a few minutes to quickly introduce themselves before we get into the discussion. So Robson, I'll start with you.
Yes, thank you very much, Elias, for the introduction. My name is Robson Mtangandura. I'm in charge of Actuarial and Research Department at the Insurance and IP Commission of Zimbabwe. I'm happy to join the panel. Thank you.
Thank you. Christine?
Hi, good afternoon, everybody. My name is Christine Hoogaard. I'm a colleague of Jeremy's, and we rolled out this research. So I'll just be adding a few more perspectives. Thanks.
Thank you very much. And let me then just start quickly with Robson. And Robson, I know we kind of gone through the study, and there are quite interesting numbers coming out of Zimbabwe, whereby the penetration rate is currently at 3.6%. If you look at also in terms of the people that have already have insurance, in terms of adults, we're talking about around 36%. And I just wanted to know, what would you say has been the biggest or the largest impact for innovation within your market last year? What are we seeing happening in Zimbabwe?
Thank you very much, Elias. Quite a tricky question. You see, there have been a number of innovations in our market. I think looking at the short-term space, I think we saw a number of entities try to use telematics, Internet of Things, machine learning to try and price their products and also to try and manage their claims. But for this particular session, allow me to look at to zone in on one of the products that was launched in our market last year. I think it's quite a novel product. It's very exciting. So before I go into detail in terms of that product, I think allow me to paint a picture in terms of our economy. I understand Jeremy tried to give a bit of the state of our economy, but I think as you are aware that over the past 10 to 12 years or so, Zimbabwe have gone through sort of two episodes of hyperinflation, and I think we all agree that the impact of hyperinflation on long-term saving is quite massive, and the economy generally is very informal. Again, which is sort of something that is unique compared to most of markets in Africa. So those are some of the things that then make Zimbabwe a bit unique in terms of its positioning in the insurance market in Africa. And in terms of innovation, entities are trying to come up with solutions that then speaks to the needs of the customer, taking into consideration the loss of value due to hyperinflation, confidence issues, and also the structure of our market. So the product that I will share with you is it's an investment product that is backed by a biological asset. So why do I call that an exciting innovation? I'm looking at an entity which tried to understand the customers and then try to come up with a product that then helps to address the customer needs. The product is targeting the marginalized or the low-income earners, and in terms of how it works. So an entity will then look at the whole saving value chain, where you then look at your customer product distribution and services, and then the customer target is your low-income customers. So when a customer pays a premium, the premium is converted into sort of some units, but these units are either some kilograms of a cow or possibly some cattle head. Why did they opt for cow as an asset backing the product? I think from their presentation to the commission when they were approving the product, some of the survey indicated that the general populace, especially the low end, were no longer confident enough to invest in your traditional or conventional asset classes, where you invest in your equities, your bonds and stuff, because of the experiences of yesterday. So they wanted to invest in an asset class that they could relate with, something that they can easily see and appreciate, to say, I'm giving you my money, I own a percentage of this, or I own so many heads of cow as my saving. And the products have got a number of interesting features. So in terms of a minimum investment, it's about $5 for as an entry, a minimum, but you can also invest even as high as what you can afford. And there is a sort of about almost 1,000 cattle head that are already in existence in different farms around Harare to back the investment. And then in terms of so the customer will then convert the investment into kilograms and heads of cattle, and as the cattle reproduce, so does the client investments. So we are saying with you buy a head of cattle, a heifer, and if that heifer give birth to a young one, then that is added to your portfolio. And then there is also a livestock insurance that will then cover the loss of cattle. So it's sort of a protection, a downward risk protection of some sort. And there's also a use of a number of technology, your electronic chip, to try and identify the cattle allocated to specific individuals as you pay your premium or as you contribute to that, so that at least the issue of ownership and administrative is managed from that perspective. And other interesting views, for example, if the heifer gives birth to a male bull, I think over a period of 2 years or so, the bull then be disposed, and then the man used to buy a female cow, so that at least you continue to reproduce. And there's also a release of sort of a realization of income through use of distributing the genetics to other people who may want to get the breeds, of course, for a fee, and that money is also used as an income to beef up the portfolio. In terms of withdrawal, I think there's a partial withdrawal is allowed in the first 2 years, where you are allowed to take a monetary equivalent of your investment. So if you own a certain kg of meat, you then be calculated the amount, you get your money out in 2 years. Then in 5 years' time, you are also allowed to fully withdraw from the fund. But after 5 years, you also have an option to decide whether you want to get the monetary equivalent or you want to get your heads of cattle. So in terms of risk management, which is one of the key areas as a regulator that we also looked at when we were approving the product, I think there's a comprehensive livestock management process in terms of your tick control, vaccination, vet oversight, quarantine measures, livestock insurance, among others. And in terms of distribution channels, they are also trying to use what they call aggregators, your churches, your community centers, your farm and stuff, Because if you then look at the size of the premium, I think the margins are so thin. So you need quite a large volume, and you also need to sweat that month so that the customers will then get value. So for me, when I was reflecting on your question, I'm trying to think which one should I pick. I thought this one was quite ideal because it then relates to issues around our target market, which is your low income earners. It's something that is outside the box. It's not conventional saving as many of us may look at it from a financial point of view. And also, it seems as if it's the right tool to do the right job. It's a product that is addressing specific customer needs. So I think basically that is the one that I've decided to pick for this conversation. Elias, over to you. Thank you.
Right. Thank you. That's a quite interesting product. I was just checking whether we are recording this session because I might have a chance to talk to my my dad. He might quickly buy such a product. But yeah, from the innovation point of view, there are two sides that we need to think about as within the insurance ecosystem. Think about the regulator on one end, and also think about the market. So maybe from Europe, so again, what are the biggest challenges that you see from the innovators in the Zimbabwean market? But also on the other end, what are the biggest challenges that IPEC are kind of facing that they see in one or the other, they cannot really adequately support innovation? So out of how then do you balance these challenges? Because there might be challenges on the market side, but also there's challenges on supporting innovation. Maybe you can give us a couple of pointers around what you see in your market.
Yeah, quite interesting. So I think for me, the biggest challenge for innovators in Zimbabwe revolve around issues of funding. I think, as you are aware, R&D, it comes at a cost. And I think there's a gap in terms of funding for research and development. And then issues around skills, especially around ICT, due to brain drain. I think because of the events that I have highlighted to you, I think we've been, as a country, we have been losing a lot of brilliant guys to other nations. And then issues around enabling laws. I think it's one of the key things that we always discuss at the commission. And I'm also happy that in our engagement with the Free, I think that issue was also raised, and we also get a number of pointers in terms of how to deal with that. I always joke to say, let's assume our regulation is a square with four corners. Then we have a product, an innovating product that is round. I think with the current setup, what we then try to do is to try to push the square to fit the circle to fit into a square. And at the end of the day, you end up having two squares. But is it that what we want? Possibly our solution was supposed to come up from a circle. What am I saying? I'm saying we have got specific requirements as per our act in terms of what are the issues that you consider when approving the product, in terms of capital requirements for entities that are joining our market, in terms of solvency assessment of different products. Then you get a new product that is coming through that does not really fit squarely in this, and then you try to find which section can we use to control this and that. At the end of the day, you end up possibly giving conditions or restrictions that will then affect or work against innovation. And also the issues around the protected product approval process. As you are aware that some of these new products that are coming in, we may not, it may be our first time to look at those products, and we may need time to try and understand the risks associated with them. How best can we protect our policyholders? And in so doing, it will be more like acting as a disadvantage to the innovators, because it will then take time to market, and among other things. And also another issue that I've also observed generally in our market is needs to balance the complementing vis-a-vis competing against market players from an innovation point of view. Our view as IPEC is there's more value to complementing each other rather than to competing, because by competing it's more like a waste of resources, duplicating the effort, trying to reinvent that is something that is already in place. But if you then complement each other, you can then create structures where you know the part A or stakeholders A is coming year to year and they'll come year to year and stuff. So those are some of the challenges that we are noticing from an innovator point of view. Again, from a regulator point of view, I think most of the issues are more like sort of a mirror image of each other. For us to approve those products, those innovations, we also need supporting legislations or acts to do that. But I'm happy that at the moment we are at a very advanced stage in terms of re-looking at our bills to make sure that we promote issues of innovation. And I also want to acknowledge the support that we got from Senfree in terms of input to our review of the insurance bill, where emphasis was then made to say we need to put market development as one of to embed market development in the act. And our view is going forward, we can then cascade that into strategy formulation, both at regulator and also try to make sure that we guide our industry accordingly in terms of innovation. And then I think another area of challenge, as I've said, I'm responsible for actuarial and research. I think those are two different departments. And we are looking at ways to capacitate our research department and possibly make it a standalone so that it can then focus on its core mandate and make sure that it plays its role in the market from a development point of view and innovation. So basically, I think those are some of the key issues that I can share as challenges, both from the innovators and also from the regulator. Thank you.
Yeah, thank you, Robson. And maybe just to go to Christine, something as you mentioned, trying to fit the square into around into a circle, and maybe just to understand, did we see some of these challenges more broadly within the other countries? Because this study, we've done it on 8 countries. We already have an innovation insurance portrait for these 8 countries. And maybe what else did you observe in these other study countries? And maybe as you answer that, I would want to hear what successes did you observe within the insurance development journeys?
Thanks, and I'll try to be quick. You probably saw me nodding as Robson was speaking, because I think these challenges that you note resonate so much across all the different study countries. Obviously, as Jeremy said, the different countries are at different stages of development and each have their own unique context. But I think the cross-cutting challenges, constraints are very clear. All the markets face structural constraints to resources among the regulator, but also in the market itself, skills as a resource, but then also for market players, funding and willing boards boards who are willing and patient enough to invest in innovation that may not have immediate returns. I think those are big constraints across the markets. Also, a big constraint that we pick up is just the process of identifying, establishing, and then also maintaining viable alternative distribution partnerships. Partnerships with tech players, insurtechs, but also your big aggregators that can help take products to market. And the intricacies of partnership management is definitely a big constraint. And then, as also mentioned by Robson, just this idea of regulatory uncertainty and perceptions around the supervisory process being daunting. Even if in practice there are clear steps to follow and there are clear rules, often when you're a new player, you're not quite sure how to engage with that, and that can be quite daunting. So obviously regulators cannot solve all of these problems alone, as Jeremy said, but what I find really heartening to see is that in all the study countries, these regulators are being pragmatic and they are thinking about more tools than just necessarily regulatory change to implement. And I think that takes me to the successes, because I think in all the study countries, we see that arguably the biggest success is that the regulatory authorities take their market development mandate seriously. And all of them can tick off successes on a number of fronts, implementing proportionate frameworks, working with the market to create awareness on insurance, awareness on innovation, prompting the market, creating forums for engagement, and it's been more structured in some countries than in others, but in all of these countries, we see these efforts already. I think another big success that we see is just efforts to streamline the supervisory process, which includes creating digital interfaces, but also just includes revisiting, for example, your product approval process and how that can be better coordinated and streamlined. So not to say that these efforts are not without teething pains, there are definitely still challenges, but it's the engagement that matters, and that we definitely see across the study countries. And then what stood out for me is that even though all the countries do face serious resource constraints within the supervisory authorities, in none of the study countries has that been an excuse to do nothing. And I think the message also from Jeremy's presentation is that even small steps and even just being present in conversations and creating that space for engagement can already get you somewhere.
Right, thank you. I know we have 2 poll questions because we are ending, and I'll encourage people to pose their questions in Q&A. And that's, I've seen one question: who keeps the cattle during the investment period? There's a poll, and basically our first poll is going like this, and I would encourage us to kind of put our choices in there. What's the main regulatory challenge to the insurance innovation in a local market? Because as we want to conclude this, I wanted to ask both Robson and Christine, where do you think we have the biggest challenge? Is it on the regulatory side or the market side? And maybe as you answer that, what is this key thing that you need to be done? I know we kind of picked a couple of issues that need to be addressed, but maybe from your own perspective, what is the silver bullet that we can start with as we answer these questions? Maybe Robson.
So thank you, Elias. So for me, I think yeah, it's difficult to say the challenge is mainly skewed towards the regulator or innovators. And I think we need to look at it from a holistic perspective to say, how can we all pull our ways together so that we achieve what we want to achieve at the end of the day? And I believe that if each stakeholder plays its role, I think innovation, we will see a lot of innovation in our market. So yeah, I think that is my comment on that.
Thank you. And Christine, I know Robson has just decided to dodge the bullet. So let me hear from Christine.
Robson, you said it so well. I think I would take the chance and put my neck out and say that I think the biggest challenge actually lies on the market side. Getting the partnerships, getting the traction, getting the funding, and also still awareness and trust in the market. So I think even though the biggest challenge may still be on the market side, that doesn't mean that regulation and the role of regulators and supervisors isn't core to helping to address those challenges.
Right. Thanks. And and that's rightly why also as FSD Africa we are also running the BIMA Lab, which basically looks at addressing those market challenges in terms of funding, in terms of technical skills. And we believe that we need to catalyze the market from both ends as we support regulators into getting or creating enabling environment. We should also make them in innovation ecosystem, particularly by providing funding, technical capacity within the insurtechs, and that kind of enables us to address some of these challenges holistically. I don't know whether we have an opportunity to bring in the second question as we close this panel and we close our webinar. Maybe if you can set up the second question, please.
So sorry, Elias. So can you come again on the second question?
Yep, I was just saying that we want to set up the poll, the second poll for the webinar before we close. I don't know whether that question can can be up. So there's the second question that what are the most powerful and enabling step a regulator can do to encourage insurance innovation? Maybe what would be the what do you guys think? What should be undertaken? I don't know whether we can also be able to view the results. So we have, do we really need to adjust the regulation? Do we really need to introduce and implement sandboxes, proactive engagement? So I think people believe that we need to get more proactive, and this is quite great because ideally by engaging, then you would be able to catalyze all the other components. That will mean that if there's need to adjust regulations, you will be able to do that. You'll be able to see whether there's need to introduce sandboxes, but also just provide some clarity on some of the key issues that innovators need to undertake, or even the market players need to undertake. Right. So I think we come to the end of this, but just to mention that we were looking at the current state of insurance innovation in the 8 countries. We've managed to come up with a portrait, and we'll be sharing some of the portraits publicly. We've agreed to share some of these reports, and that kind of gives us an opportunity to come up with a process and a strategy to solve those particular challenges. We have clear action plans for each and every country that we undertook this particular study, and through the R3 lab, we are going to ensure that we do implement some of these particular action points that have come out of this particular study. Mine is just to thank you for really attending the webinar today, but also just I want to also thank the panelists for really enabling us to kind of share the ideas. But maybe before I do that, I don't know whether there's a question from the attendees. I'll want to take either only one question, if there's one question from the attendees, because we are basically running out of time, and maybe if we can allow one question from the attendees, if there's a question. Right. Great. So we want to really thank all of you for attending, and as I have mentioned, kindly keep on tabs with our website. We will be sharing the portraits with all of us. We are also going to share the presentation with the people that have attended this particular webinar, but also just keep on track with what we are doing on this particular space. We are going to launch a number of activities to support the 8 countries that we've conducted this study. We are also going to look at which other countries that need support from FSD Africa, but also with our partners, Sendfree. Mine is just to thank you very much for taking your time to join this webinar. Until next time, enjoy the rest of your day. And also thank you to Jeremy and the rest of the team. Thank you.
Thank you. Bye.
Thank you. Bye.